Morning. I wanted to discuss the upcoming recession that we're going to be kind of facing probably maybe the next year, the next couple years, who knows. So what I wanted to really do is take a look at a lot of the advice that's been coming out of, say, the last 10 years or so, and compare that to what we've been seeing and experiencing over the last 50, 60 years, just to kind of put things into perspective, because there's a lot of advice out there that is very, I would say, dangerous to follow, given our current economic climate and moving forward into the future. So to show you what I mean, let's have a look down below. What I'm showing you here is this is what's called a Case-Shilling index, and really all it is the way to think about it is kind of like an S&P index, but for real estate prices across the country, right? And it goes all the way back, say the late 1800s and the early 1900s, and it's just showing all the different rises and falls with real estate. Up here you can kind of see this major rise right here, just to kind of put things into perspective. That was the 2008 crisis that we had, which caused a major drop in real estate. Now I'm showing you this just so I can go ahead and move to this. So this is the same graph as I showed you before, only with a blue line now. And what I did is I went through and added these gray bars, and the width of these gray bars represents the recessions that we've had throughout our history. So right back here you can see like the early, 1929, here's 1930, 1929, to basically 1936 or so, 1937. This was the Great Depression. For some of us that might remember, here is the early 80s. 81, 82, that was a pretty bad time. 86, 87, the early 90s, right here, 91, 92, and that correlates with these are called drawdowns, by the way. When you go from high to a low, these are called drawdowns. So there's a drawdown in the real estate market. For those of you that follow Dave Ramsey, and you listen to his story when he was talking about how he was a real estate investor, and when he went bankrupt, it was because the banks basically called his loan and forced him to, because he was highly leveraged, to pay up, and he couldn't do it. Well, this was the time frame that had happened. It happened in the early 90s. We were just in a recession, and the real estate prices were falling, and he had difficulty selling his properties because the prices were falling, and he couldn't recuperate his money. And this is what led to him going bankrupt. We have the 2001, early 2000s, 2001. There was the stock market crashed basically because this was the dot-com bubble burst, as well as September 11th. And then finally we have a recession leading up to and occurring right in during the time when the real estate market took a major crash as well. Right? So this kind of overlays what the economy was doing as well as what the real estate market was doing. A lot of the current investing advice is taking place coming out of these last, say, 10 years or so, right along up in here. This is the advice that says, don't have an emergency fund, don't even have like a 401k, put a bunch of money into real estate, leverage a bunch of properties, don't worry about paying off your house, don't worry about paying off low interest debt. And it's all coming out of this time period right around here. I'm going to use this little square right here, and this little square is going to represent 10 years. So from here to here, that's 10 years. And you can kind of see that it matches between the last recession, which was the 2008-2009 crash, and right along into, well, basically today. There is, if you look at this, and if I move this along, you'll notice that there's no other 10-year period in history, even if you go all the way back, even all the way back to the Great Depression, where we have not experienced some form of a recession or a drawdown in the real estate market. These last 10 years are incredibly unique. They haven't happened like this in history. And the problem that I'm really seeing that really worries me is that a lot of people are giving advice on how to manage finances and how to grow and build wealth only using these last 10 years where they have not experienced any kind of a bad market. And that is a very dangerous proposition. It's very good and lucrative for people that, say, bought during this when everything was down and low, but it's very dangerous because the applicability of that advice any other time frame would be very detrimental to your wealth. All right? Case in point, instead of 10 years, here's 15 years. All right, let's move the 10 years out of the way. All right? And in 15 years, you can see we've definitely hit a recession here. This is why in my video when I was talking about comparing two funds and looking at the returns, I don't look at 10-year returns. I want to look at a 15-year return because that will at least include the last major recession that we had, and that was a big one. But again, with the possible exception of maybe here, which was right after the 90s crash and a real estate crash, you still had to go through the bubble, the dot-com bubble burst, and 2011. I mean, real estate was doing pretty good, but then right at the end of that, you had a major crash right here. So again, this is really, just imagine taking advice from over here and applying it here. It's a very dangerous proposition. The other thing that's really kind of interesting to note is if you look at where all of these major drops in real estate happen, like there's a drop right here, drop right here, drop right here, one right here, one right here, they pretty much are all leading right from the beginning of a recession. See, a recession starts here, recession starts here, recession starts here, skips here, but a recession starts here, skips this one, and a recession starts here. So recessions in the economy and drawdowns in the real estate market kind of go hand in hand. Now, another major point that people who are investing now like to use is they'll say, well, take out a 30-year mortgage, because a 30-year mortgage means you'll have the lowest mortgage payment, monthly payment, which means that you'll have more money for cash flow that you can now, for investing. Here's 30 years. And as you can see in this 30-year span, even here, it's 1, 2, 3 recessions with 1, 2 major drawdowns in real estate. Any other time in history that I can't position this any way where I'm not going to cross any kind of, probably at least a couple drawdowns in real estate. Right? And remember, every time that there's a drawdown in real estate, that means that there's usually unemployment rates are going up. Unemployment rates go up when obviously recession starts, when you start hitting a recession, but a recession starts hitting, unemployment rates start going up, people start moving out because people want to live where they work. Well, if people can't work anymore, then the real estate values start going down. And obviously, and even if you're renting, even if you are renting out to people and you're collecting rent, you're going to have to at a minimum start lowering your rent checks and lowering your rent payments. So your income is going to take a hit on that. And the other thing that this doesn't account for is anything that's going on in your life. Think about the last, whether it was 10, 15, or 30 years. Maybe you got married, maybe you got divorced, maybe you had a kid, maybe you lost someone important to you, maybe you moved, maybe you changed jobs. There's a lot of different things that happen personally. All right, if you go through, let me move these. If you just imagine going through this 30-year period right here and going through 1, 2, 3, 4 recessions with 1, 2 major drawdowns with another one just a couple years coming up along the way. Imagine going through all of that and whatever personal issues that you have going on. But I think about the advice that's coming out of this time period right here, this latest decade. And that is, don't pay off your mortgage, don't pay off your low interest debt, don't worry about about some kind of 401k because it's a scam or whatever it is. Leverage a bunch of properties and everything. Well, just imagine that advice being applied to any other time frame like this. Imagine going through imagine going through this time period right here of 1, 2, 3, 4 major recessions with 1, 2 major real estate drawdowns and whatever personally is going on with you. But now imagine going through all this with 5 to 6 leveraged properties. And now you've got a bunch of debt that you may or may not be able to pay that off. Imagine going through this without an emergency fund because you put your emergency fund into the stock market and just let it rise because that's what you were told. Why have cash sitting on the side when it's going to lose value it's going to erode due to inflation? Imagine now going through all that plus whatever personal issues you're going through. Would you be able to handle something like that? Maybe. I don't know. But now imagine going through this debt-free. Imagine going through this with a paid-for house, with a fully funded emergency fund, without having to worry about any kind of debt. Okay? All you'd have to do now during these bad times is just ride out the storm. Whereas before, would you have come out ahead? Maybe. Who knows? It's a gamble and depends on how much you can stomach. And depends on also what kind of an investor you are. And I'm not saying that you shouldn't be doing heavily investing and taking risks and all that other kind of stuff. You should definitely be doing that, especially if you're young. However, my criticism is on a lot of the advice that's coming right around here, which is don't have an emergency fund, don't pay off your debts, don't pay off your mortgage, because a lot of that advice, it was very applicable back in these last 10 years. Back in here, you really scored if you did that. But as you zoom out and look at the macro scale of things, because there's no reason to believe that this kind of pattern won't continue out here. As you zoom out and as you start looking at what the economy is going to be doing as a whole, a lot of this advice is going to falter. The reason why advice like pay off your mortgage, put money into your 401k, have an emergency fund, it's boring advice and drab advice. But the reason why it still exists today is because it has stood the test of time in the past when things have gone crap. For me personally, I'm not going to be trying to time the market. I might be a little bit more conservative with the way I allocate my investments. I might be going a little bit more into bonds, but I'm not really going to be changing a whole lot of my investing strategy. I'm already debt-free, so that's a real big bonus, because that really takes a lot of the stress out going forward into a new recession with that kind of issue. The other thing that I'm really going to be focusing on is probably putting some cash to the side. And I mean, ideally, we're going to be looking to save or to buy for a house here coming up. So hopefully everything kind of starts taking a little bit of a nosedive so we can capitalize on that opportunity. So anyways, hope you guys really enjoy that. And I'll talk to you guys later and have a really great week. See ya.